Welcome to another episode of Ask Our Experts. My name is Alethia O'Hara Stephenson, President and founder of the Dufferin County Canadian Black Association. On behalf of the entire board, I'd like to thank you for joining us for our 9th installment of Ask Our Experts. Tonight's episode is on tax planning for both your personal taxes as well as your small business. Before I get into tonight's session, I'd like to go over some housekeeping items. The session, of course, is being recorded. If for any reason you don't want to be on camera, that's fine. If you have questions, we will have question and answer period around the 7:35 mark. We ask that you submit any questions that you may have either in the chat, or you can use the raise your hand feature and ask your question live at that time. We ask that you kindly keep yourselves muted unless you are speaking or you're asking a question at the question and answer period. Any question that we don't get a chance to answer tonight, we will definitely be cataloging these questions and making them available to you via email after the session. So rest assured, if for any reason we run out of time, all of your questions will be answered. Also, at the end of the session, we will ask you to kindly share any feedback, any comments that you have on the session, on the event, on the speakers, on DCCBA overall in the comment section. These comments are very helpful for us when we look for sponsorship, when we go out to the community to share the great work that we are doing. So your engagement is highly appreciated. So before I introduce our next speaker, let me just get my notes up. Our next speaker for the night is Joshua Bacchus. Actually, before I get into his bio, let me share with you, for those of you who are new, a little bit about the organization. The Dufferin County Canadian Black Organization was established last year, just over a year ago in June of 2020. The organization's goal was to advocate for the needs of the Black community in Dufferin County. We are, of course, headquartered in Shelburne, and we are a nonprofit organization. Our mission overall is to demonstrate leadership, advocacy, and provide relevant education, resources, and training to enhance, elevate, and celebrate the Black communities throughout Dufferin County. We envision a Dufferin County where Black communities have equitable access to all opportunities and resources to improve their quality of life, participate in and contribute to the development and growth of society. Again, on behalf of the entire team, board of directors, I welcome each and every one of you here tonight. Now to introduce our very special guest, Mr. Joshua Bacchus. Joshua is a certified financial planner. He has over 10 years of accounting and financial industry experience and a wealth of knowledge that allows him to bring practical solutions to his clients. He works with individuals and small businesses, families, as well as corporations to provide a range of financial services. He's a well-rounded professional, and his expertise has allowed him to share his knowledge with the community. Joshua has also, because of his passion for helping his community, he has pursued higher education in the field of, he holds a business admin diploma from Humber in finance. He also holds a Bachelor of Commerce from Ryerson, majoring in accounting. He also holds a number of designations in the financial sector that allows him to bring that expertise to his clients in all of his dealings. So he's a CFP, he's a CPA, and he's a CGA. So I can't think of any other person to trust with my financial needs than Joshua. And I can attest to the fact that Joshua has done my taxes. So I can attest to the knowledge, the skill, the patience, the expertise that he brings to his dealings when he is dealing with his clients. So without further delay, please, you can use your happy emojis, you can use your hand clap emojis to welcome Joshua to the forum. So Joshua, please welcome. I'm happy to have you sharing your knowledge and your expertise with DCCBA. So thank you for joining us tonight.
Thank you for having me, and a great opportunity to share with all of you tonight. So thank you for joining with us tonight, and I'm excited to share what tax knowledge I do have and how we could definitely know how to position ourselves and minimize the taxes we pay. So without further ado, we will get started with tonight's presentation. So as you all know, living in Canada, we do have to pay taxes. And, you know, taxes is not necessarily a bad thing. We understand living in this great country that, you know, the highways we drive on, the healthcare system, especially amongst things we've seen with COVID, you know, all of our taxes do go to pay for these things that we do use on an everyday basis. So we do understand the importance of taxes. And even with, you know, when people were not able to work, we saw that how CRA stepped in and was able to give CERB and give assistance to individuals, to companies. And really that all comes from our tax dollars, right? It just goes in a really big circle. But when we needed it, we saw that they did step in and kind of give us back money that were already ours, but when we needed it, they gave it back to us. So understanding the importance of taxes and why we need to pay them, and definitely how to minimize them is very important. So we understand, as we could see on our next slide, that there are different types of tax returns. So as an individual, we are used to filing our personal taxes. This is normally if we get a T4 from our employers, or if you know, you have a business, you may be declaring this on your T1 return. So essentially, this is a normal tax return that each individual is required to file as long as you're 18 years old and over. And most every individual in Canada is required to file a T1 return. And then there's other types of returns, such as a corporate tax return. So if you have a corporation, you may be familiar with filing T2 returns, as well as T3 returns. So upon you know, somebody passes away, they might have to file a final tax return, a T1 return. But even after that, they might have their estate might become a trust that has monies in it that the beneficiaries use over a period of time. So that's also required to file its own tax return. And that is what we call a T3 return. And then there are other types of returns for like other organizations, such as charities and stuff like that. But today we're just going to be focusing on items that are particular to the T1 personal tax return. So we could see in the next slide that why is it important to file a T1 return? There's a couple reasons. It keeps our information updated. Like for example, we have voting coming up. So we want to make sure the address and everything that we do put down on that T1 return is correct, because they do ask you a question regarding about voting, so that Elections Canada knows what address you're at and what able to send you your voting card. So that's number one reason why it becomes important. So your information is kept up to date. And also, when you file, you may be eligible for some credits, such as the GST tax credit and the child tax benefit credit. So without filing your T1 personal tax return, you could actually be missing out on these credits. So essentially, you may be accessible to the GST or HST tax credit if your family's net income is under a certain amount. So essentially, this is just a credit. We all have to pay HST on the items that we buy. So the government has kind of just put a mechanism in place that individuals that are under a certain threshold in their net income are able to receive a reimbursement on the HST. And this is why you may get HST or GST quarterly. So in order to make sure you get this credit, if you do meet the credentials, then you would need to be filing your T1 return every year. And without doing that, you actually will lose out on this credit if you were eligible to receive it. And we could see even with the next credit, which is the Canada Child Tax Benefit Credit, on our next slide. We could see that this credit, some of us might have known it as the Universal Child Care Benefit, but this was replaced with just the Canada Child Benefit. And again, this is an amount that if you have children, you are eligible for a credit. And again, depending on your net income will determine how much you would receive in Child Canada benefits. And it used to be taxable, but after 2016, when they converted it to the Canada Child Benefit, it is not taxable and you don't declare it on your T1 personal tax return anymore. But again, if this one, actually, if you don't file your T1 return, and you would lose out on the GST credit, but this one, they would go back for like 10 years and give you back any child tax benefits that may be back owing. So if you haven't filed a tax return, this could be an opportunity where you could get funds that might be sitting waiting for you if you do have children and you meet the requirements. So as we continue on to our next slide, we will see that there's other important information that I just think is important to disclose on your T1 return. So there are questions that are asked about if you have foreign property in the property that you own. And the only reason I bring this up is because sometimes I have clients that actually have property outside of Canada, wherever, you know, if it's Jamaica or Africa, wherever it may be, right? They own property. And then they're not really sure how to answer this question because it says that if you hold foreign property with an adjusted cost base of 100,000 or more, you have to disclose it to CRA. So all CRA is asking regarding is that if you do have property with an adjusted cost base, meaning that if it was bought for 100,000 or greater, they just want you to be disclosing this information. So they're just keeping track of it at some time when you do sell it. You know, anytime we sell any property, regardless if it's worldwide, we're supposed to declare the gains on our tax returns in Canada. So again, that's why CRA has kind of put this question in place to make sure they're kind of tracking that information. But I think where people get confused, and I just want to help clarify, is that even if the property wasn't $100,000, you're still, if you sold a property, bought it for 20 and sold it for 50, you are still required to disclose that income, any worldwide income, on your personal tax return. So why does that become important? And then why does this become an issue for my clients? Because they might have sold a property in a previous year and now they want to bring the funds over to Canada. But even with bringing anything over 10 grand could raise red flags. So that's why you're supposed to disclose it. So then what would happen is you could get dinged with a penalty. I think we might see that on the next slide. Is it on my next slide there? Yeah. Oh, okay. Well, that's a different one. But we could see we could get a penalty by not disclosing information. And so, you know, you don't want to be caught in that position. So if we do have monies that we do have outside of the country, and we need to plan on bringing it back here, you understand why declaring it in your taxes might be very important. The other question that CRA asks in your T1 return is about selling your principal residence. So if you have a home that you're living in and you do end up selling it in the year that you're filing that tax return, you're supposed to disclose it. Again, just another tracking mechanism for CRA of when people bought their house to when they sold it and qualifying for that principal resident exemption. And this is easy if you bought your house and sold it and you lived in it the whole time. But where it could become complex is if you bought the house, you lived in it for a little bit, and then you turned it around and rented it out, right? So then this becomes complex in the sense that now CRA wants to determine what was your resident exemption while you were living in it those years, and then what would be the capital gain from the year that you moved out to when you sold it, as that would be considered rental property at that time. So again, just important questions. And normally these are questions that when I'm doing somebody's tax returns, I'm normally asking them these generic questions. Did they sell a house in that year? Do they own foreign property in that year? And it's just normal questions CRA asks. But hopefully that may have clarified any understandings with that. So as we continue, we could see the important thing to understand is that we all know when we receive income, we get taxed on it. And this is important to understand because the top tax bracket in Canada is 53.53%. That means for every dollar, if I'm in the top tax bracket, for every dollar I make, I'm getting taxed 54 cents. So the government's taking more than what I'm taking home. And regardless, if I know most of us are probably not in the tax bracket yet, of course, but regardless of what tax bracket we're in, we understand that, we have to pay taxes. And so how to minimize the taxes that we have to pay and retaining the dollars that we keep in our pocket can be very important, especially with times like this where costs are going up and expenses and inflation. So knowing the dollars we can keep in our pocket can become very important. So we could see when we know how much income we have made in a year. Now, there are certain deductions that we are allowed to offset that income. So for example, if I made $60,000 of income in a year, then I know I'm going to get taxed on that income of $60,000. But the government allows me to deduct income. So if I'm allowed to offset that income, then it reduces how much taxes I could pay based on that income, that it becomes the net income after the deductions. So ones that we're familiar with could be like our pension plan deduction. So every year you may be paying into a pension. And so that automatically gets put on your T4 and it causes a deduction on your income as well. Another one could be your union dues or professional fees. So if you are paying into a union, it could also be on your T4, or maybe you're an electrician or a nurse, and you're paying the college separately. So you may want to make sure you're keeping those receipts and statements and giving them to your tax preparer to make sure you're any deduction you're eligible to receive, that you would be able to get that. So you would want to do that. And then another major one would be the RSP deduction. And that one's a huge one because you can control how much income you can, if you're looking to stay under a certain income, RSP is a major way that could help you. So how I would explain that further is, for example, like I said, if I made $60,000 of income for a year, every time I get my paycheck, there's taxes that are deducted on my paycheck, and I get my net pay. So if I have $10,000 to put in RSP, I'm able now to offset my income to $50,000. So whatever taxes was collected on that $10,000, I would actually get back as a refund, right? Because instead of being taxed on the $60,000 of income, I would actually be taxed on the $50,000 of income. But since they already took the taxes for my paycheck, I would essentially get all those taxes back in refund. Also, if you're a small business owner and you know how much you owe taxes, you're used to paying taxes at the end of the year, then you may want to do some tax planning to see how much RSP you could put in that may help reduce that taxes that you have owing at the end of the year. So RSP could be a big help in that. And of course, the understanding of RSP, because I know some people don't like it or may not understand it, but to really understand how to use the RSP is created that the income you make today, if you're in a higher tax bracket today, but that you can defer that income to take out in a later year when you are retired, essentially, when you're in a lower tax bracket, so you're getting taxed at a lower tax rate. So the way that RSP was created is that you are able to offset that taxes today by deferring that income so that you can pull it at a later time in life when you're in a lower tax rate. So if you do put in RSPs and then you end up pulling it in a year when you're in the high tax rate, and then you're wondering why, and then you have to pay all these taxes when pulling RSP, it's because it's not designed for us to pull it in the year. But sometimes we have to because of emergency, so that's understandable. And the other great things about RSP is such as you can use it to buy a home. So instead of pulling it for retirement, you're allowed to, without being taxed, to use it to buy a home up to $35,000 for a down payment, as well as using it for as a student to be a student loan against yourself without being taxed on it. But as long as you repay it back over a 15-year period with a home buyer's plan and a 10-year period with the student learning plan. So those are some major deductions. Other ones are like if you have an investment. So maybe you decided to take out a loan to do investments. You're able to deduct the carrying charges and interest on that loan. Also, the one that we had to be familiar with for 2020 was the for our employment expenses that you may have been eligible to deduct because you were using your home due to COVID. So a lot of us may have had work from home. So that the government had given us two options to either use a temporary flat rate, or you were able to provide all your expenses that you were using, your heat, your hydro, and these types of expenses. And depending on the calculation, you were able to get a deduction for that as well. And otherwise than that, that was because of COVID. But normally, commission employees are able to use those deductions on a normal basis if they're using their home, or if your employer is allowing you to use your car for business, or using your home office, or using your phone, they would give you a form at the end of the year with your T4 that would enable you to claim those expenses if they're not reimbursing them for you. So those are other major deductions that we want to look out for. So as we carry on, so as I talked about there, that deduction now will reduce the income that you will be taxed on. So if I made $60,000 for a year, I could have now deductions up to $10,000. Now I'm only taxed on $50,000. And that $50,000 now becomes whatever tax is payable. So now after I determine my net income for the year and my taxable income, I know this is how much tax is payable. But we all are eligible to credits, non-refundable tax credits that help offset those taxes that we have to pay. So think of it like this. When we go to the grocery store, right, we understand that this is the bill we have to pay in our groceries, but then we have coupons that help offset how much we have to pay on those groceries, on those items. So the same thing, you could think about it with our taxes, that these tax credits are kind of like coupons, and we want to understand how we could apply them to offset those taxes payable. So we see normally in Canada, everybody has the basic personal amount, is eligible for the basic personal amount tax credit. And that's normally up to $13,000 in credit. So essentially, what does that mean? If I make about $13,000 in income, I know that I wouldn't really have I wouldn't really be owing any taxes per se, because it would be offset by this credit alone. Other credits include the age amount. So when we become 65 and older, we are able to get an extra credit, which would help us offsetting the other income that we're receiving at that age. And again, these are credits the government has put in place to help people in that age and that tax bracket to help receive them, make them keep more money in their pockets, right? Spousal amount is another important credit where, so if one spouse is working and the other one isn't, you essentially, like I said, you get $13,000 in credits already automatically. And so then if the spouse is not working, you get their credits as well. So if you are filing together as a couple, either common law or a husband and wife, then you could be missing out on these tax credits, because sometimes the information needs to be shared. Even if you're using different tax preparers, you want to make sure the tax preparer knows the income on your spouse's or common law partner's tax return, so that you can be eligible for any extra credit. So essentially, if you're making over $20,000, any taxes you paid, you would essentially get it back right away if only one spouse was working. Another major one is the first-time home buyer's tax credit. So that's another one you don't want to miss out on. If you bought your home for the very first time, you want to make sure you let your tax preparer know, so that they're able to help you get, it's like an extra $500 back in your pocket. And especially when you just bought a home, every dollar counts, right? So that's another major one we want to know. And as we continue, this is the eligible dependent amount. So again, if you are a single parent and you have a child, and so the government now allows you that you don't have a spouse, but if you have a child, they automatically give you those credits as well. So even now you have your 13,000 basic personal amount credit, and instead of having your spouse's credit, they give you this eligible child, so you still get that $26,000, and it becomes a big help, especially as a single parent. Other credits include the adoption expenses and if you have adoption, and again, that's why it's important to explain to your taxpayer your situation, because you may be missing out on coupons or credits that you didn't even know you were eligible for, and you are in that situation, right? And Canada Employment Amount and Pension Income Credit is that if you're receiving T4 income, you're automatically getting that credit. Also, if you're receiving pension, you're automatically getting these credits, right? And as we continue, we will see here, this is what your tax return will look like with all the different tax credits that you would be eligible for that we went through. Now, I just want to go through a couple other major ones before we turn it over to questions. So if we go to the next one. So the Canada Caregiver Tax Credit. So essentially, you may have a dependent. It could be your child, could be your spouse, or it could be your parent. And they're dependent on you because of a physical or a mental infirmity. Then these gives you back tax credits that you would be eligible for. So if your child is disabled and dependent on you, right? Then you are automatically get these amounts, and these become huge because you may be having to pay extra expenses to take care of that individual, maybe even if it is your parent. So this is the mechanism the government gives us by utilizing tax credits to make sure that we keep the dollars that we really need in our pockets, so that we can make sure we can take care of what we need to do in our lives. So in this situation, you may just want to keep on record that, a letter or something from the doctor stating that the person, whatever that mental or physical infirmity is and what they're dependent on you for. Again, these are the things you're looking for are a basic daily living, like eating, bathing, dressing themselves, taking care of everyday things. So those are the items you're looking for and being able to qualify for this credit. The next major credit is our disability tax credit. So these ones kind of go hand in hand. So if we go to our next slide, we could see the disability tax credit. Again, you may be able to be eligible for this, or your child or whatnot could be eligible for this. And even if it is, the credit would be transferred to you. So even if your child is disabled, right, or your spouse is disabled, the credit can be transferred to you. So it will help offset, because if you have the more income and you're paying more taxes, then it makes more sense for the credit to be transferred to you because you get back more tax dollars than the individual who's not making any income, right? So we want to be understanding of if you're eligible for these tax credits, not you, but even if it's somebody that's dependent on you, how do we do this? Well, you would have to get this T2201 form from your tax preparer, and then you would give it to the doctor. And the doctor would then fill out this form stating the disability. And then we send it to CRA. And if CRA approves that it meets the criteria for disability, they're going to give you this tax credit that you get to use every year that would help offset those taxes we pay. And they'll go back up to 10 years. So if you have not known about this tax credit and you've been taking care of an individual in the last 10 years, then I would recommend to look into this, because this could give you a really big refund in the last 10 years, because it would go back and adjust the last 10 years of tax returns, right? And if you had that higher income with the taxes, you'll get back a lot of taxes, which could be very beneficial, especially if you have medical expenses, because that's what happens right with disability, and that's why the government's trying to help us in these areas. So the next one we talk about is the tuition and student credits. Again, this is on the federal level, that if you're a student and you would receive a T2202 every year. So you want to make sure, normally you would have to log in and download it, where you normally go for your records for your university or college. And essentially, you want to make sure that there's two things. Either you're tracking it in the years that you're receiving it, so that when you do have a lot of income, when you do start your first job, you're going to get a huge refund, because these credits are carried forward to those years when you do make income. And again, it could be very beneficial to helping you, help save for that down payment of the home, or helping you pay back that student loan that you had to use for your education. The other major thing is, if your parents you can transfer that credit. The parents can get that credit from their child because the child's not working. So it's transferred to the parent, and if the parent's paying that student bill, again, here's some taxes to help, the refunds to help offset those taxes payable, and we can use that credit as well in that area. So you want to make sure that if you do have children in university and college, you are looking for those T2202s at the end of the year and bringing them to your tax preparer to determine what's the best use of those tax credits. And also for your student loan, any interest you're paying on your student loan, you want to make sure you're giving them that statement every year, because also you get a credit for any interest you paid on student loan. And on our next slide, medical expenses, another major credit if you're paying for whatever medical expenses it may be, your prescriptions, or you're paying for medical assessments. So you want to make sure that you definitely do try to get whatever you're able to claim that may help offset, again, whatever tax is payable. So this is another major one where it could become more important, maybe even in the later years when we're senior and things like that. And I think that covers, charitable donations. I think this is my last slide. So this one, huge as well. So when we give donations, we get a 15% on the first $200 and 29% on the excess of that over $200. So this becomes a huge coupon. So we know that we may want to give to a good cause, or may be given to our church. And when we understand that with the charitable, when we do get those donation receipts, those can become a huge help with offsetting our taxes and getting us that refund. So what I would do is, even in tax planning, what you may want to do is, maybe you were thinking of giving a large contribution to an organization, and you weren't sure how that may affect your taxes. And same with your RSP. So you may want to speak with your tax preparer and say, hey, what would happen if I gave this donation this year? How much taxes would I save, or how much refund would I get? Same with the RSP. And so that would kind of give you a better idea if you were planning, or maybe you would want to save it in a year where you are where you have a higher tax bracket. So these are things where through tax planning could become very critical, and how we can reduce taxes. And I believe we will turn it over. For businesses. So this is for businesses that have their small businesses. These are some expenses that you would be able to claim. So it becomes very important when you have income. So sometimes I see people show me they got all this income, but they didn't keep good records of their expenses. So the only way to reduce how much taxes that you're going to pay when you have all this income you receive is by keeping track of your expenses and providing those numbers when we're preparing your taxes at the end of the year, because that will help reduce the taxes you definitely have to pay. And we could see on my next slide there that when you do have a small business, you're eligible to claim. You have to use your car for your business. So you would want to make sure you're keeping a log of how many kilometers you drive for the year. So you check your odometer at the beginning of the year and the end of the year, and you're just keeping track of how much kilometers you're using for business. And then we know how much is for personal and for business, and we use that percentage in determining how much expenses for your car. And the same goes for your home. So whatever the square footage of your home is over the office space that you do use, we're eligible to use those expenses to help offset whatever income you receive. And I believe that wraps up my presentation, and I'll turn it over the floor for any questions.
Perfect. Wow, that was a lot of information, a lot of useful knowledge that you shared with us tonight. I'm just check the chat to see if we have any questions. Perfect. Thank you, Samira, for your comments. Good, helpful info. Thank you so much. Yes, so I will turn it over to the audience for questions first before I go to my pre-submitted questions. And I see Deputy Mayor Steve Anderson is on the line and he has a question. Thank you for joining us, Deputy Mayor Anderson.
Thank you. Joshua, first of all, that was a fantastic presentation. I joined a bit late, but what should be clear is there are good people who provide and knowledgeable people, professional people who provide sound advice, and there are those, unfortunately, who don't. And certainly you fall in the former category. Here's my question, though. When I was younger, not too long ago, there were people who would approach and say to me, "Hey, Steve," and this is pertaining to the charitable piece that you mentioned and how beneficial that could be. I love the coupon analogy, by the way. And they would say, "Hey, listen, come and do your taxes with me, and I could get you a massive refund by increasing your charitable donations." And a lot of people ended up in trouble. Joshua, what would you say to folks if somebody approaches them with these kinds of I wouldn't call it get rich, but certainly promises of a major refund? Come with me. I'm sure you've probably heard about these things, but I want to make sure that our audience are not falling into these traps.
Absolutely. Thank you, Deputy Mayor, for your comments. And that's an excellent question. So as you're seeing, like for me, what I tell people is that, I studied tax law, so all I know is how to follow within the tax framework that we've been and what's allowable. So if we understand what's allowable to us, then why do we need to go outside that framework? So we, as you're saying, and we did see it, it was all of those things were red flagged when it came up. People were doing these donation receipts where you pay $100 and they give you $200 in donation receipts. And all of them got red flag. So when somebody like this, if they brought it to me, there's two things. I would give them the advice to say, look, I would look at the charitable donation receipt and I would look to make sure it meets the criteria of CRA, meaning it has the charitable BIN number on it, it has an address, right? It has everything that CRA requires on a charitable donation receipt. So that's, I guess, number one on my job to make sure, because sometimes you as a person may not know what the requirement of a charitable donation receipt looks like, right? So I'm making sure that this meets the requirement. And maybe it passes that. Maybe it does meet all of those because they did an excellent job in creating that template. So if the person then is asking me that, well, this is, they went to somebody and they received these donations and they do that, I'd be like, number one, that sounds like a red flag, just like with anything else. And I would be hesitant on claiming this. And the reason why I'd be hesitant on claiming this is this, because you're going to claim it this year, but then 3 years later, CRA is going to come knocking on your door saying that we disqualified this tax receipt, this donation receipt, and we're actually asking back for all that money we give you, plus penalty, plus interest. So you actually end up losing at the end of the day. You didn't make money, right? So I think giving that warning to the person, now I would say, okay, because if they still want me to end up doing it, well, I've warned them what could happen and I've washed my hands clean of it from there, right? But definitely we know that those become red flags, and people that have been burned with that, know not to even touch that ever again, right?
Just my last follow-up, Alethia, if you don't mind, just very quickly on the fact that the long arm of the CRA will eventually come back and get you. For those who do fall into tax difficulties, sometimes there is that monstrous bill at the end. All of a sudden, CRA says you owe 10,000, 5,000. Instead of ignoring that, what are some of the steps that people could take to try to work with CRA? What are the options with respect to maybe paying down that bill instead of ignoring it? Because if they do, certainly, Joshua, you could speak to some of the consequences if you don't resolve your account with CRA.
Absolutely. So what essentially happens is that if you're not filing your taxes on time, the CRA is going to assess you, and then they're going to come up with their own numbers and taxes owing. And if that happens, right, then you could be paying more taxes than you actually are owing. So the first steps you want to do is, like I said, if you're not keeping proper record keeping of expenses, or maybe if it even is donation receipts in a year or whatnot, you could be losing on credits that could have helped offset those taxes. So the first thing I would want to do is, if you've been assessed and you have to owe all this money to CRA, you want to go review those years they're assessing, and then determine that the information CRA is saying they have is accurate. And if it's not, we're going to come back at them and say, well, there's other ways that we can reduce that taxes owing, and they have to allow you to do that. And that if you've objected within that time period, you have 60 days to object to whatever assessment they make. So you would have to make sure you jump on that, right? And like, even it could become where somebody owes money on, like, because they did HST and these kinds of things, right? And CRA then again assesses you on and you didn't file it on time. So you could have helped reduce whatever HST owing if you had all your receipts and all of that about HST you paid into. This again can help reduce that. But then we're still stuck with a tax bill. We're still stuck with a balance owing. And as long as CRA, you can't run from them, right? You can't run from them, right? Until we die, they're there. So the key is to making sure, and you don't want the headache on your family. You don't want your family to have to deal, because if you don't deal with it now, the estate's got to still deal with it, right? They're gonna get it at one point or the other. So the key is definitely to make sure you work out a payment plan with them, right? As long as they know you're paying, they'll be willing to work, with what you can, right? And that means even they might want to review your financials. They want to review, they might ask you for an expense or a cash flow statement to see what your expenses look like. And again, they just want to help determine what you can pay them on a monthly basis, right? So it's very important not to be afraid of CRA, but they're there to work with us in whatever, predicament that we are in.
Awesome, thank you. We have a question in the chat. You touched on it briefly in your presentation, but since the question came up, perhaps you can elaborate. I was wondering about income splitting between spouses to reduce the higher earners' tax payable. Can you touch on that a little bit?
Yes, income splitting. So that becomes more like when we are doing like pensions and stuff like that. So when you're normally in retirement and stuff, you receiving a pension, and that puts you to paying higher taxes. So you're able to split that income with your spouse. That would help you reduce the taxes you have to pay. Also, you're eligible for OAS and GIS when over you're 65. So income splitting at that point becomes very important in the later ages when we're in retirement. But in terms of other ways like that, when you're a spouse, I think we covered I think I missed the childcare expenses. It becomes another very important way in reducing your income as a deduction. So that's another way that, you know, between spouses, it's reduced on the lower income spouse unless if the spouse is, you know, going to school or something like this, they meet the requirements, then you can try to do some income splitting in that kind of mechanism. But otherwise, when we are just a normal and not in retirement, there's not really too much income splitting, right?
Perfect, thank you. Ian, does that answer your question? Do you have a follow-up? You can just drop a note in the chat or unmute. Okay. The question that I have for you, Joshua, when it comes to, thanks, Ian, when it comes to nonprofit donations, say, for example, you make a donation, you know, to a nonprofit organization this year, and in 2 years' time, whatever time frame, they gain charity status. Can you now go back and claim, get a tax receipt for the year that you donated? Or that is completely gone?
Unfortunately not. So it's just when they receive charitable status, and in that year that you receive that donation receipt, that would be when it would be effective.
Okay,
right? So
perfect.
even if it was prior to, but it's really when CRA grants the organization charitable status.
Okay, excellent. You touched on a really great point when it talks about retirement planning. And one of the things that I personally want to know, how do you set yourself up where you're planning and you know the amount of money you will need for retirement? And how do you, you know, at whatever stage in your life, whether it's in your 20s, 30s, 40s, 50s, 60s, whatever, how do you look at your current retirement allotment to see what the projection would look like for when you hit 65 to determine how much you need to adjust?
Absolutely. I think retirement planning is very critical, very, very critical. And, you know, we want to look in it sooner than later. And even for somebody like myself, when I'm looking at these numbers, I'm kind of worried about it because I'm young. And what's young, right? I don't know, 36 is not really young anymore. But the point is that when I'm looking at retirement, and if I'm looking at a 3.7 inflation rate, whatever somebody's looking at retirement now, I'm looking at triple that to retire. So it is very concerning of retirement and planning and how to save for that, because as we know, money is scarce, right? There's only so much dollars we can make in a day, and there's so much expenses we already have. So how do we use each of those dollars to save, to put away, to pay down our mortgage? So planning can become very important to meet those goals, because yes, we all want to have to pay off our mortgage before we retire. But then one of the sayings that my father says is that, can you eat the brick and mortar in your house, right? So people rush to pay off their house, but then they have no cash to live on for the rest of their life, right? So that's why planning could become very important, because you could still save and still make sure that, you know, you can afford to live. And even if it is continue with a small mortgage after retirement, right? So these things become very important. So what we would want to do is you want to kind of look at, first of all, you need a budget, right? You need to know what your budget is today. And if you have your budget today, now we could project what your budget will look like in retirement, right? Because your expenses may change in retirement, but kind of will be the same, right? We normally say, based on statistics, 70%, whatever your income, whatever you look like today on expenses, maybe it becomes 70% of that in retirement. Plus, you're going to do other things in retirement. Maybe you want to travel. Maybe you got other plans that you need to do, which cost money. So these are all things you want to make sure we're putting into our calculations of what our expenses are going to look like when we do retire. So once I determine my expenses, now I'm looking at, okay, how much income am I going to receive in retirement? So again, I might have a pension I'm going to receive. So I look at, you know, how much pension I'll receive in a year. I'm going to receive CPP. I'm going to receive OAS, right? And then maybe I have RSP income as well, and things like that. So determining now, I can see, okay, this is how much income I'm going to receive. This is how much my expenses are going to be based on inflation and all of that. So I look at what the costs are today, and I times it by inflation when I project to retire. And then I would know now the difference of how much income I'm coming in and how much expenses I have. And then I know if I have to reduce my expenses in retirement, or do I have to maybe prolong retirement? Because then there's only certain options we can do, right? Because now, this is all the money I have saved up for retirement, right? So maybe I have to prolong it now to cover those expenses in future years, right? So these are all calculations that we would want to take a look at when we are determining to make sure we're sufficient in retirement, right? And again, that becomes important and with retirement and tax planning go hand in hand, because we want to try to maximize the benefits we receive while we're in retirement. And that means receiving old age security. But there is a certain threshold that after about $80,000 of income, the government CRA will start to cut back how much OAS you receive. And then even once you were making like over 120,000, then you lose all that OAS income, right? But if you're able to income split, as Ian was talking about, right, then we know that, hey, I can cut that in half and we can still receive the maximum benefits. Or as well, this is where I talked about RSP can become complex, right? Because you're receiving a pension, you're receiving all this other income. Now you don't want to pull too much from your RSP that it is going to affect your OAS. So this is where those things become retirement and tax planning can definitely go hand in hand.
Perfect. We have about 5 minutes left. Any questions from any of our small business owners, entrepreneurs on the call? A1 Fitness, any questions? Okay. I have another question, and you touched on it briefly around, was more around having a second property, but this is more specific to rental income. So you've got, how does the tax work when you have a rental property and you're gaining revenue from that property through your tenants, really? So how do you declare that and what are the implications?
Absolutely. So, yep, you're absolutely supposed to be declaring that rental income that you're receiving from your tenants. And essentially, you're eligible to be any expenses that you're paying on that property. So essentially, if you are paying the heat and hydro and that's all embedded into the rental income that you're receiving, then you'll be able to offset that, right? So you want to make sure, because sometimes we declare the income, but then now we're paying taxes on the top dollar. But if you're not recording those expenses, then we want to get the net income, and that's what we're going to pay the taxes on. So, the other major strategy really when you're thinking about rental property and taxes is that the mortgage. So if we want to take out a mortgage or take out more money on our mortgage of our house to go buy rental property, but the key is that you're allowed to deduct mortgage interest. Whatever interest you pay, you can deduct it against the revenue you're receiving on the rental income. So, but if you go and take a bigger mortgage on your personal principal residence, then you could be losing out on that deduction. So you kind of want to do some planning there with your mortgage advisor and with your tax preparer on how you could position yourself that the mortgage could be maybe higher on the rental property. And that way you can have the higher deduction to help offset that rental income.
Perfect. My very last question, and it's around working from home. So those individuals who are working from home and they're employed by an organization, what is it that we can ask our employers for if we qualify? But just to start the conversation, what is it that we're asking our employers for from a deduction perspective so that we can bring to our tax professionals?
Right. So essentially, if you are somebody that is in a position where you might be having to use your car for work, so they require you to go visit clients, or it's part of your, part of the job that you have to travel, right? So essentially, you want to make sure that if you are not being reimbursed for it, essentially you could be being reimbursed from it, and then it's considered a taxable benefit, and it's already included on your T4. But if it's not, and it's all just part of the job, then they're going to provide you with a form at the end of the year, right? That they would say, these are your expenses that you are, and they might not. That's why you're asking. You may want to ask for it because you're doing these things and you're not claiming it. So you definitely want to ask your employer to say, hey, I would like to claim the expenses on my taxes, and they would definitely be able to provide you with the form. The other major ones is, again, using your home, right? So if you have an office, you have to come, your employer requires you to work from home sometimes, or you have to take your work home with you, right? So again, you would want to make sure, is there anything that the employer will sign off to allow you to claim those expenses. And cell phone would be another major one. And if you're a tradesperson, it could be using your own tools, right? So maybe you are a mechanic, right? So you have to use your own tools. So and then you have to buy them, right? So again, these are other deductions that you would want to look out for.
Perfect. That brings us to the end of our session tonight. And on behalf of the entire board, I'd like to thank you for your time. If anyone wants to get a hold of you, how can we get a hold of you to ask you more information, to engage you for your services? How do we get a hold of you?
You could contact me on my website at www.joshuabacchus.ca, and definitely send me a message on that, and I would absolutely respond to you from there. And I guess I could just touch on Ian's question very quickly there. You take out money as a capital gain rather than employment income. Okay, so let me kind of just answer that quickly for you. So there's only two ways to take out money from a corporation, and that's either through payroll as an employee, as you're the employee, and then that way you're submitting source deduction to CRA on a regular monthly basis. That would be the CPP, EI, and taxes are deducted, and we're submitting that to CRA. So that's the first way you could take out money from a corporation. The other way you're supposed to take out money from a corporation is through a dividend. So you could take out money and then you have to cut yourself a dividend. And again, this is then how we would show the income on your personal tax returns, is either through the T4 or a T5 from the income you took out from a corporation. As far as a capital gain, you wouldn't be able to take out a capital gain from the corp. Unless if you sold the corporation and you made money on it, then there's a capital gain. But in terms of taking cash out of the corporation to pay yourself, it only could be done through payroll and dividends.
Okay, awesome. Thank you. Before we close out the session for tonight, please make sure that you drop your comments in the chat. Let us know how tonight's session was. And of course, we'll share the feedback with Joshua. Before we go, I'd like to remind everyone that these sessions are held the first Tuesday of every month. The next session will be on insurance. So essentially Insurance 101 again, providing the foundation, much like tax planning session tonight, making sure that everyone has all the right information that they need. Special thanks again to Deputy Mayor Steve Anderson for joining, Ian Daly, Jordan Stevenson, Josh McEwen, again, always here supporting us, Alethia, Richie, and Richard from A1 Fitness Studios. So thank you so much for joining us. And Joshua, on behalf of the entire team, thank you once again for your time. And last but not least, please make sure that you check out DCCBA's website and of course our merchandise store. All of our merchandise sales go directly back to the organization. And of course, you have the opportunity to donate. Someone has their hands raised. Go ahead. I'm not sure who you are. It says iPhone.
This is Richard from A1 Fitness. Hi. Thank you so much for having me. I really appreciate it. This was super informative. I need his number so he can do my taxes.
Not a problem. I will make sure I send that over to you, Richard. Thank you so much.
Thank you. Have a great rest of your evening.
Excellent. Thank you so much. So that's it, everyone. Thank you so much for joining us. Another amazing session. Join us in October. Oh my gosh, it's October already for our next Ask the Expert session on insurance. Thank you, everyone. Thank you so much, Joshua. This was awesome.